Good afternoon, ladies and gentlemen, and welcome to the Van ELLE results presentation. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via vanelle@walbrookpr.com. The company may not be in a position to answer every question it receives during the presentation today. However, the company will review all questions and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, I would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive Mark Cutler and Chief Financial Officer Graham Campbell. Gentlemen.
Thanks, Tom. I'm Mark and this is Graham. Thanks for joining us. We'll quickly run through a series of slides that talk about the FY24 results. Hopefully you can see the screen. And then we'll spend a little bit more time than in previous presentations on the outlook in growth markets that we've built, in our opinion, very strong positions in, because we think that will really help all of us to understand the potential as we move into stronger market conditions that I think we all expect will return in the near future. FY24 was certainly a challenging year in terms of the wider construction industry, confidence, delays, inflationary pressures, a gap between investment cycles in infrastructure and, of course, depressed housing market, all conspired to pretty much come at the same time. All very much as expected, a little bit worse in a couple of areas, but also one or two things that went ahead of plan. But in the round, we've delivered exactly what we said. So there shouldn't be any surprises in the results, I hope. And we've come in with a set of numbers that are in line with expectations and certainly as we signposted as we approach the year end. So consistent profit margins with last year. We'd like to be going faster. We certainly feel we will be, but in the circumstances, we think we've done very well, and we've developed strong positions in the growth areas that I'll come on to later. We've been busy investing time and effort with customers and indeed diversifying overseas as well as with capability in the UK. Again, I'll come on to that later on. And really, in terms of the balance sheet and the dividend, no surprises whatsoever. All very much as forecast, and hopefully that's all appreciated. In terms of the markets that we operate in, just a quick summary. This is in the UK really. On the face of it, a good balance between residential, which includes traditional house building, open market and partnership housing, but also taller residential schemes, often for the same customers, depending on which part of the country. A lot of taller stuff in London, of course. And infrastructure, which is a combination of rail, roads, and to a lesser degree, some of the utility sectors, water and energy. But of course, rail is a niche area for us. And regional construction, which is effectively building, combination of commercial schemes, mixed-use schemes, manufacturing and industrial, warehouses and prisons, a whole mixture of things that very much take place through regional construction companies, and the dynamics do vary around the country. Much wider, more fragmented marketplace. But the point is we're diversely spread across all three. That gives us a certain protection against cyclical investment pressures. And what we saw in FY24 was very similar trends to what we've seen in previous years. We are deliberately pushing more into infrastructure. We are more selective in construction because that's where we see the biggest commercial and credit risks with some of our customers. And we see the least mature procurement processes, quite frankly. And in housing, we've done more than probably we thought we might do at the start of the year. And some of the bigger resi has been more resilient. We would expect that to typically be a bit lower than 41%, on a similar level to regional construction, because the margins are a bit lower. And that mix in the round gives us a very good spread to manage our workforce and manage our workload. But as I said, nearly all of those sectors really struggle to some degree with the wider macroeconomic climate during the course of FY24. So we've had to work hard to deliver the revenues that we've reported. Graham, do you want to take on from here?
Thanks, Mike. So from a take a quick run through the P&L balance sheet and a quick review of the divisional performance. As Mark said, really no real surprises down the face of the P&L. A decline in revenues as we expected. Revenue down 6%, and you may be aware that we acquired Rock and Alluvium from Galliford Try at the end of November. So we've got 5 months worth of trading in there, which accounted for about 8 million. So on a like-for-like basis, revenue is down 12%, which I won't reiterate the points that Mark's just made, but challenging markets. Very pleasing to see the gross profit performance improving. There are two major factors in there, one being the positive mix impact, which we benefited from lower, a decline in the housing volumes. So we had a very strong first quarter within our housing division, and then as has been widely publicised, much more challenging following 3 quarters. And of course, our housing division is at the lower end of our margin range. So when the revenues decline, with a slightly higher proportion of our higher margin work, and that's had a positive mix impact. But more importantly, I think we've had better contract execution, fewer issues on site. What teams have delivered really efficiently, really well in the year, and that's delivered a margin improvement overall. Of course, we've still got some inflationary pressures. You don't have to go back too far to recall days of inflation running up at 10%. So there have been some inflation challenges, and we're working hard to keep those under control, particularly around efficiency projects and some cost-saving measures. But overall, it's delivered a reasonably healthy looking EBITDA, and broadly a underlying profit before tax broadly in line with last year, just slightly down, which overall, I think given the market challenges and the decline in revenue, we're reasonably pleased with. I'll just touch briefly on finance costs. We are importantly now in a very low debt position. We inherited a modest amount of debt from the acquisition of Rock and Alluvium. They're hire purchase contracts, and at the end of the year, we had 2 contracts remaining. So overall, total HP debt is 500,000. That will clear within the next 12 to 18 months. So very modest levels of debt, which of course you can see there the impact of finance costs reducing. We have cash on the balance sheet, which I'll come on to very shortly, and that of course we're now in a position with a stable cash balance to invest that money and gain some interest for probably the first time the business has been able to do that is in the last 12 months. In terms of the 3 divisions that we report against, general piling, specialist piling and rail, and ground engineering services, just very briefly in turn. General piling has seen an improvement in revenue, but an underlying reduction. Of course, this division has had Rock and Alluvium integrated into it, and with 5 months of trading, that delivered, as I mentioned, 8 million revenue. So overall, on a like-for-like basis, there has been a reduction in revenue, but more importantly, coming back to the margin performance, we've seen good, strong margins delivered right across the general piling division, and that's shown an operating profit improvement year on year. In the prior year, we benefited from 2 very, very large contracts, which were at slightly below normal margin levels. This year, we've done more contracts, but we've delivered them efficiently and got a better return. Specialist piling and rail, Screwfast forms part of that division. That Screwfast solution, that's where we report it. Broadly, a small reduction in revenue. 2 very different stories. Specialist piling had a very challenging first half with a drop off in activity levels, but come back very strongly in the second half as we signposted at the interim results announcement. Rail has had the opposite impact, which is a solid start to the year, but as CP6, the Network Rails Control Period 6, has come to an end the second half of the financial year has been much more challenging, and we don't really expect to see the volumes in CP6 ramp up, in CP7 ramp up until 2025. Mark will touch on a bit more detail around the rail sector on a later slide. Overall, margins have held relatively flat, and the impact there and the reduction that you can see in operating profit is primarily the investment that we've made into the Canadian rail business, and we'll touch on that on a later slide. In our ground engineering services division, we've got formed of two parts. 80 to 90% of revenues come from our housing division, and of course, the housing market has been very challenging. We saw a very strong first quarter, as I mentioned, and the team's done actually very well, I think, over the remaining quarters to achieve break even while the market conditions have still been very difficult. But what we have importantly done is retained all of our capability and people, so that as the market recovers, and we expect it will, we're well placed to take advantage of that growth and return back to more historical levels. So the challenge really here has been a reduction in volumes, and you can see that flow right through into the operating profit reduction. Strata, which is about an 8 million turnover business, ground investigation part of the business, performing very well. Historically, we deliver sort of 50% gross margin, so it's a high margin part of the business. Lots and lots of small contracts, a good addition to the group structure, a lot of cross-working across some of our other divisions, and I'm pretty pleased with the performance there overall. In terms of the balance sheet, not a huge amount to say here, other than it's clearly backed by a significant fixed assets balance. So, the backbone of our balance sheet is a heavy investment in our assets. And we can see there's growth year on year, and that is a capital spend internally of 5.5 million. And as part of the acquisition that I mentioned, we brought on the books plant and equipment of 2.9 million as well. So continuing to invest in the fleet of the business. Working capital is up a little bit, primarily due to a very strong end to the year. We had a very big revenue performance in April, and of course that hits our receivables position. We've also got an R&D tax claim there, which is very normal, slightly bigger because the scheme that HMRC offer has improved. And so we've made a bigger claim that sits in debtors and causes a bit of a working capital increase. But overall, we're trading at sort of normalized historical working capital levels when you look over a rolling 12-month basis. And the final point really is, I think from a balance sheet position, a funds position, we're in a comfortable position, a comfortable place. Lots of businesses out there in our sector are struggling. We're sitting with a healthy cash balance, 6 million at the year end, very low debt, 500,000, as I mentioned earlier. And really the only other, the number that sort of brings us to 1.6 million net debt, which most people discount anyway, is the IFRS 16 lease liabilities, and we've got 7.1 million of those. And importantly, we still have the 11 million funding facility, which for those that have joined this call before be familiar. Undrawn during the year, a very important safety net, provides us great scope for growth and managing working capital ebbs and flows if should we need it. There's a bridge here on the cash flow. We've moved from 8.9 down to 6 million, as I just mentioned, as the closing cash position. You can see there a healthy operating cash flow. The normal things we've seen, working capital growth, which I've talked through, a significant amount of net capex. The acquisition cost there is twofold. It's the first tranche of the rock and alluvium payment, which is 1.8 million, and then the final tranche of our acquisition of Screwfast Foundations, which we completed in April 2021. Normal levels of repayments of loans and borrowings there, and of course the dividend, which we returned to the dividend roll a couple of years ago post pandemic. So I think broadly cash is looking reasonably sensible. There's a capital allocation model here. We haven't published this before. I'll just touch on it very briefly, but clearly our priority is to maintain that strong balance sheet, disciplined cash management, keeping debt low, and making sure we've got enough cash to fund the normal working capital cycles. In terms of second priorities, investment for growth, So given us the capacity really to use our cash to grow organically, Canada would be an example of that, but also to reinvest in the fleet and make sure we've got that market-leading fleet that we have 132 rigs, and make sure that they are operating efficiently, modern rigs. And also give us the capacity for strategic bolt-on acquisitions. Clearly we don't have huge volumes of cash, but we have enough to be able to complete small bolt-on acquisitions from cash resources, which is what we've demonstrated over the last 2 to 3 years. Third priority, I think, remain on the dividend distribution. We expect dividends to grow in line with earnings, but it is a prudent dividend distribution, simply because we see strong opportunities out there in the market, both for organic and acquisitive spend. And then as a final priority, we've got distribute X cash. I think we're not in that position at the moment, and with the opportunities that you will see on the next few slides, I think you'll see we've got plenty of opportunities for spending our cash. Quick reminder of our strategic targets there on the left-hand side. Priority really operating margin getting up to 6%, return on capital 15 to 20% is our target. We're obviously hit the leverage, and in more recent years, annual revenue growth, we've got into the 5 to 10% compound growth rate. And a quick reminder there of the two acquisitions that I've just mentioned: Screwfast in April 21 and Rock and Alluvium earlier in this financial year.
So it's probably worth actually, Graham, reminding where we are right now in terms of these results. The operating profit margin is 3.9%, flat with last year, and return on capital. I don't know if we put that into the presentation, did we? But we're somewhere between.
I mean, we've progressed from the pandemic years to grow our operating margins. We're currently 3.9%, as Mark said.
In terms of the growth segments that we are focused on, these are effectively all of our sectors. Really, we see growth in all of them. The housing market is no doubt reasonably well reported, and won't be any surprises here to see that the new government and commitments around housing volumes and easing the planning restrictions, the potential for reduced mortgage rates, are all very positive signs that will stimulate the construction of new housing around the UK, both open market sales and major volume house builders, and partnership and affordable house builders. We work for both, and we have a little bit of resilience as a result of that. We also have a very smart system called SmartFoot, which allows house builders to complete schemes faster and modularizes the foundation construction process to get out of the ground with less risk and less resource. And in brownfield locations, that's got distinct benefits. It has as well, even in greenfield locations, but we think the benefits of our system will be exacerbated. And we've been busy developing initiatives to prepare ourselves for the growth ahead. We announced just before our results expanded facilities for our precast factory to deal with higher volumes of precast pile manufacture, a collaboration with M&J Evans, who are a like-minded national groundworking business, where we see the benefits of integrating our capabilities on major house building sites, and a big scheme for Keepmoat in Nottingham that will be the trailblazer for that, which we're both awarded to. And early indications within our own business in terms of order intake are very positive. We are 30% up on Q1 last year in terms of orders so far. Very early days. Those orders don't necessarily translate into starts on site with any real absolute firm timeframes, but it's all moving in the right direction. We're expecting increased activity levels materially from FY26. If we see some of it in the balance of this year, then fantastic. I split our views on the rail sector into two, one for the UK, one for Canada. In terms of the UK, obviously Network Rail are the dominant procurer of rail contracting services, and we've been transitioning, as Graham explained, from control period 6 to control period 7. Control period 7 started April 2024, but it is normal to spend a year in the first year designing and scoping projects, because all of the regions in Network Rail's world on the right hand side re-procure frameworks at every control period. So the deck chairs move around and the procurement models change and our customers change as a result. Now, good news is that the winning contractors for the CP7 awards, and they haven't all been announced yet, are household names that we have developed deep relationships with during CP6. There are not many surprises to us, and that will take us quicker into CP7 than we would have done 5 years ago, where we were still, in my opinion, developing some of those relationships better. We've also been diversifying our customer base and secured a major framework direct to Network Rail in the southern region that is mobilising. We should start first projects in September. That's a 10-year deal potentially. And we have a major project that is almost spanning the transition period on the Transpennine route upgrade, which is now underway at a reasonable scale and will only get bigger and will extend for 3 or 4 years. And we are in a very good position in terms of the scope of services we're providing across Manchester, across to Leeds, and either end as well. It ultimately goes to York and out to connections out to Liverpool. Very important programme for us. And on our horizon is the next major electrification programme in the UK. This is very stop-start, unfortunately, with Network Rail, and this will be the Midland Main Line electrification extension to Sheffield, which is long awaited in the industry. But I think it's fair to say all of those things together, once they come through, including the stations that I reference here, look good. But I think we're looking at FY26 and FY27 for it to really gain full traction, if you excuse the pun. But at the end of the day, I feel a lot happier going into CP7 than I felt going into CP6. Now, the other initiative that we undertook was to diversify further beyond just the UK into Canada, because we felt that the cyclical spend in the UK and the lack of confidence that not just us but the wider supply chain in the rail industry felt with patchy investment meant that we needed to do something much more sort of radical to allow us to achieve what we wanted to achieve. And as I've explained in previous presentations, we selected Canada after an international review of opportunities, and the conditions in Canada absolutely fit very well our capabilities and the timing for us providing these expanded services. So 12 months ago, we mobilised into Toronto on the face of it initially to become the delivery partner for the Toronto network expansion pictured on the right, which is enormous, far more than we could do on our own, by the way. But of course, we're faced, as may be predictable, with delays and disruption that really made FY24 quite a challenge. We've invested and reported a loss of just over £1 million here operationally during FY24. So the results that you've seen have absorbed this investment, and we are now in a position coming to the end of Q1 where workload has ramped up significantly. We have a diversified customer base as a result of not waiting around for the Go expansion program. We're on the verge of being finally the preferred bidder for the latter, and have developed a customer base of industrial customers that's proved to be much more easy than we thought it might be, and has proved a very attractive contracting environment for us, and we're delivering services that frankly don't exist in North America, let alone in Ontario. And the pictures at the bottom here are the sort of things I'm talking about, which is road rail-based equipment delivering line-side works. It doesn't have to be piling and foundations. And this technology is not as advanced as we've developed in the UK off the back of our experience in CP5 and CP6, let's say, and is in high demand already. We only have 4 machines in the country and a team of 8 people, but they are now flat out, and we're planning the next shipping of equipment and the building of our team over the rest of FY25. A 40 million Canadian dollar bid pipeline. We're winning 80% of what we're bidding, and really pleased with progress. We'll deliver a profit in Canada this year, we expect, and start to demonstrate the investment we've made has been well worth it. The water sector is not a sector we've talked about frequently in these presentations because we've not had a real focus on it, if I'm honest. We bid projects all the time, but haven't really invested dedicated resource into a deep understanding of the needs of the sector and the relationships both with water companies and the tier one contractors. The good news regarding the contractors is a lot of read across from rail to highways to water in terms of the infrastructure divisions of our major contractor customers. So it is quite achievable for us. And we've used the opportunity of the arrangement that we have put in place with Galliford Try to accelerate our progress. It was part of the rationale of the Rock and Alluvium acquisition, and particularly thinking about water, and that is progressing well. And we've been building up schemes and developing designs, planning projects, and as Galliford's are getting visibility of the schemes that are coming through, either at the back end of AMP7 or or into early stages of AMP8, we are now there with them, and indeed one or two other customers who have similar scale of ambitions in the water sector. So we're quite pleased with progress. This is in the context, of course, that the spend in AMP8 is almost double what it was in AMP7 for, again, well publicised essential reasons why more infrastructure needs to be built or improved across the UK. And this it's equally important for Scottish Water, who are regulated slightly differently, and working all across the country in every region of with every water company at the moment, it looks like. So we're really pleased with progress. One thing that we do in water, and this is a theme, is that we have differentiators that are different than our competitors. And right in the middle of this are two initiatives. One is the Screwfast acquisition from April 2021, which was always very strong for highways, but as I'll come on to, that hasn't quite worked out as we'd hoped in terms of that market growth, but works very well in water in terms of modular steel foundations that are speedy and efficient with repeat standardized designs, but also our civils capability, which we've developed organically, goes hand in hand with the foundations work that we do, because these works interface with each other. We've been doing this in rail for a couple of years, and it works very well. And sometimes customers want the combined service, a bit like what I described with M&J Evans in the housing sector earlier. It reduces the interface of people tripping over each other, working on simple stuff that could be done by one party. The stuff we do is more complicated, so we're starting from a strong position to do ancillary civil engineering works around us. An even more exciting, in our opinion, growth area is energy. There is again, well-publicised commitments from Ofgem and the asset owners to upgrade, replace, provide new connections for the transmission network, and indeed the more local distribution networks. Bringing green energy connections onshore is behind a lot of this, as is replacing worn out infrastructure, often 50 years or more old. We're doing quite a few transmission towers that are where the foundations have failed, for example, at the moment, and effectively creating the capacity for the country's security and low carbon needs into the future. This is, again, essential infrastructure. It's not optional. We're pretty confident that the frameworks that we're seeing announced, almost on a week-by-week basis in different parts of the sector are going to proceed at pace. We've developed frameworks of the back-to-back of some of these major announcements with the tier ones that are going to be delivering a lot of this work. Not everybody, because we're selective about who we will work with. Again, we're focusing on customers where we have a read across from other infrastructure sectors where we're familiar and we have a good level of trust and understanding of the relationships. But we also have a good track record in transmission and energy infrastructure. We've done over 100 substations, for example, within the group. Quite a few, the majority of which were done by Screwfast over the years. And we have done a lot of transmission related work and onshore wind farms, for example. And you put all that together, we've got a very good combination alongside our unique capabilities, which are very similar to water, with having the ability to do all foundation types and civils in difficult locations with complex foundation techniques as required. And we are quite different in that respect, and so confident that we'll be in a leading position going forward. Again, this work isn't really going to start in earnest into FY26. There's a lot going on now in terms of early design and planning with the partners that we're working with. I wanted to mention highways because, perhaps contrary to popular belief, it's been difficult for us in the last couple of years in highways. We were very disappointed, of course, that the Smart Motorways Alliance didn't turn out to have the potential that we thought it would have at first. We've ended up probably delivering 10 to 15% of the volumes that we would have expected at one stage, but we delivered them very well, and we've made the most of our position on that framework nationally. The photo on the left is one scheme, for example, of a retaining structure we've done on the side of the M1 recently, and we've done several others. We do all the gantries now on the Smart Motorway Alliance using our Screwfast foundation solution, and Strata, our ground investigation business, are out doing ground investigation on highways all over the place, have a national framework with National Highways that's been growing during the course of FY24. As we look forward into what the highways, or National Highways, call RIS3, which is their investment programme, where I feel more confident than I would have felt 12 months ago. Part of that is helped by Galliford Try's presence on several schemes that are visible to us and have been through the delays and environmental challenges that affected many highways projects over the last year or two. And that's a greater level of visibility than we normally get, if I'm honest. And we have one or two other partners of a similar pedigree, in which we've emerged as not their sole delivery partner, but certainly one of their preferred. And that gives us a lot of confidence that we're making good progress with those customer relationships. And again, those are the same sort of customers that we're seeing in the other sectors I've mentioned earlier. BAM being one of those, for example. And then finally, in regional construction, which is a more fragmented market, more nebulous, difficult to focus on consistent customer relationships nationwide, because the delivery of the enormous amount of building work that goes on in the UK is spread across regional offices of building contractors or regional contractors that only operate within certain geographies. And there are many, many different projects and project types. So very diverse customer base. We're very careful here with customer credit and their ability to make good the payments to us as we deliver the work. So we put a lot of effort these days into governance around creditworthiness. But we do see areas of growth here. Again, compared to 12 months ago, the acquisition of Rock and Alluvium gives us a much stronger position in London and the South East, which is a bigger market by fact. And our pipeline in London South East has grown significantly as a result, by combining Rock and Alluvium with a wider Van ELLE capabilities. But also there are emerging trends of strong investment in data centres, industrial schemes, battery factories. Warehousing is still strong. Our expanded precast factory helps us with that as well. And also prisons. The MOJ programme for prison construction, again, gets a lot of press, but we are seeing now the start of the new prison programme starting to hit early site works. And we are involved with Waits, who are the leading framework partner in multiple frameworks that exist. with delivery of several of their schemes on quite a close partnership basis, which we're very pleased with. Again, we've put a lot of time into that. So we see opportunities here that are a bit more structural than perhaps some of the high volumes of bidding that we've always done without really maybe seeing the progress in individual segments. So looking forward to further progress in this sector as well. And if I was to rank all of these, this might be further down the list, but still moving in the right direction. Near the top would be energy and water and rail in Canada as the fastest growing segments, but all of the ones I've just mentioned should be delivering increased revenues as we go forward over the next 3 to 5 years.
Just a brief update here. I won't go through. There's a very detailed slide. Obviously, you can use it for reference. I mean, just showing our commitment to our CO2 reduction plan. Sustainability, our efforts in the year have ramped up significantly on sustainability. We have a senior level working group with representatives right across the business looking at our sustainability policies. I think we've had a huge amount of activity in the year that I won't cover off here, but a couple of highlights. We held a sustainability open day in our head office at Kirkby. Customers and suppliers visiting, demonstrating products, their sustainability efforts, sharing ideas. And I think I'll just touch briefly on social values, social efforts. We have, I think, punched well above our weight for the size of company that we are in the local area. We've got a huge amount of our team here have contributed to local schools, local parks, local council initiatives. So much greater profile within the company. And as I say, there's a reference there to our targeted reductions on the route to 2030. Much of that in the left-hand column, 2022, is delivered now, and we're now focusing on 2025 as we move into next year.
Okay, yeah. So in summary, we've achieved a lot, we feel, in the year that we're reporting. Resilient set of results. We would like to go faster, but with market conditions starting to align towards the ambitions that we have for the business. We're still we are constantly assessing acquisitions and monitoring, smaller piling contractors that might be feeling that the time has come to call it a day. We bought some assets recently from a company called Fussy Piling, which fitted in perfectly to what we wanted to do. We're mindful that we need to keep a handle on working capital as we grow, but we believe we've got the funds to do all of the things we want to do organically and through potential bolt-on acquisitions over the next few years, all towards delivering and no doubt hopefully outperforming the medium-term financial KPIs that we've listed here. That if everything falls into place, there's no reason we can't do these by FY27, but certainly in the range FY27 to FY28, allowing a bit of wriggle room is certainly achievable.
Great, super. All right. Thank you, Mark. Thank you, Graham. Now, if we could turn to the questions, we've had a number of questions submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. Mark, if I could start with you, we've got a couple of rail questions that are a bit like question of sport. We've got one home, one away, and we'll start with the home one if we can. John asks, did Sunak's decision to axe the northern leg of HS2 reduce expected future prospects?
Yes, it did. Yes, it did, John. Unfortunately, it did. We would have expected to have put in place the embedded delivery partner position that we did not get the chance to do for phase one, because those decisions were made in 2014, 15, 16. We were not ready as a company at that stage. We were certainly ready by the time phase two came along. I would have expected we'd have teamed up with one of the leading bid teams and been successful. We had already won a ground investigation framework for the whole of phase two, direct to high speed 2, in only a couple of weeks prior to these things being cancelled. So that unfortunately came to nothing. That would have transformed the size of strata, perhaps doubled it. So we were pretty disappointed, but yeah, it had an impact on us.
Okay. And the away question, how quickly can you scale operations in Canada?
Well, we can go pretty quick. We are the only UK business, probably international business, that has figured out how to adapt the technology of the sort of kit that I was talking about to work on the Metrolinx network, which is not a straightforward process. It involves quite complex engineering and adaptations to the equipment. We've done that. We have 4 rigs out there at the moment. We've trained operators, and we've achieved all of the essential licenses that are needed to work on the Metrolinx network, unsupervised by anyone else, and built a team that's absolutely amazing. Nobody else has done that. There are domestic contractors, obviously, that have licenses, but they don't have the kit that we have or the operators that we have, and don't know how to do the training. We have 7 more machines from our UK fleet that we are prepared to send across, because this ends up being an excellent opportunity to maximize utilization of the assets that we have. And we have 3 more machines coming into the UK anyway that we ordered 12 months ago. So we have plenty of options for rigs. We have a workforce we can build on. We've got the unions right behind us, working with us. And we've got a customer that's pulling us into more and more work all the time. I'm hoping to convert the preferred bidder on the Go expansion project into an award in the coming few weeks. And that will then give us the ability to plan with a funded commitment, a reimbursed commitment, to put some of this extra investment in place. What I won't do is repeat the learning that we had in FY24, where we thought the work was there, we sent the kit, and then the work just was delayed, and we ended up struggling a bit. We think this time we're in more control of the timing of that, but we can do it quite quickly.
Great, super. Question for you, Graham, balance sheet based, from David. What are the £8 million of provisions under current liabilities? And the second part of his question is, what was the pounds quantum of the legacy contract dispute?
Yeah, it's a good question, David. You're pleased that somebody's reading the detail of our annual report. So look, the majority of the 8 million provisions on the balance sheet is largely a gross up in relation to the legacy contract dispute that we had. This is a claim from a contract dating as far back as 2014. So very old legacy contract, certainly predates Mark and myself. It's been long disputed. The challenge here, the judgment here, was whether the claim against us would fall within the insurance program that we have under RPI cover. And that's the judgment that we've been making over the last 4 years. Our view has always been that it would fall within the insurance cover. And so the accounting treatment has been to effectively gross up the balance sheet. So you'll see a corresponding debtor for the amount that we estimated would be settled at, and a corresponding provision, and that is certainly the majority. There are some smaller provisions within there that make up the total 8 million. I guess the key point to say here is that this is now resolved, and it did resolve in line with the judgment within the insurance cap. So when you look at our interim accounts, you should see that provision number dropping down to much more normal levels. Of course, there will be normal provisions, as you would expect in any business, but the big gross up will drop off by that next time we report.
Super, thank you. Focusing on growth and M&A, Andrew asks, with a strong balance sheet and undrawn bank facility, what are the key areas of focus for bolt-on M&A and organic growth investments moving forward?
I've probably, I think, answered all the organic growth investments. I mean, the investment would be in those areas, CapEx and working capital, which we can plan, and we have the CapEx identified in budgets and business plans going forward, and it's within the envelope of normal annual investment. We don't think we're going to have to go crazy here. We will also, a bit like Canada, we will also divert rigs to areas of better utilization, higher returns, where we need to as well. And I've said this to some of our customers. I will quite happily divert capacity from our precast factories into the energy sector if there's a big demand for precast, for example, compared to some of our lower margin works if necessary. Some of the work we do with warehouses can be quite aggressive terms and conditions and not quite as collaborative. So why pursue that if I've got big substations that might demand some of our support? So we can, we'll divert resources to get the best returns. In terms of M&A, it wouldn't be a surprise perhaps if we'll stick to the UK, and we would be looking at where we need to strengthen either niche capabilities or resource depth in the localities where major investments are perhaps beyond our normal resource base. Scotland might be a good guess. You'd think to places where we might want to strengthen our embedded presence, that sort of thing. Looking at the sort of sectors and the sort of capacity that's needed to deliver in those sectors. That's where we'll be focusing.
Great, thank you. Just focusing on energy and water, what does the competitive landscape in the water and energy sectors look like?
It tends to be the same people we see time and time again, often subsidiaries of tier one contractors, in which case we steer away from working for those contractors. The difference is that we have unique capabilities compared to some of those rival companies that I've mentioned in the presentation, and that allows us to not only maximize our market share with companies that don't own their own piling company, but also we think influence the way that lines are specified by National Grid and SSE and significant opportunities that we're in discussion about. Galliford Try, for example. So wide range of customers and a competitor landscape that we're quite familiar with and we understand. Water's the same, okay. Different work.
Great, super. I lost a little bit there. I don't know whether that was you or me, but we'll just move on quickly. A couple of questions from Paul, and you may not be able to answer them actually, but I'll read them out. First question is, ex the Canadian turnaround, what would you expect profit? Would you expect profits to be ahead in the current year? And I guess that's probably one you can't answer.
If I understand what that means, will we make a profit in Canada this year? Yes, we expect to. Will it be ahead of what we currently expect? Well, I'd hope so. If things carry on the current trajectory, we've set quite modest targets for this year in terms of profit because of we're not quite sure when we did the budgets how it would go. There is the opportunity to outperform that if we continue to make such good progress. As we look forward, then the contributions in Canada could be quite material to the group as we look forward to FY26, 27, 28. But we've got a long way to go before we're putting those into the group's forecasts.
I think Paul's question may be in relation to sort of excluding the Canadian turnaround, which obviously should deliver should deliver an improvement year on year. I mean, the market consensus for next year is a profit of 6 million broadly, and so clearly having just delivered just over 5 million with an investment of about 1 million or so in Canada, that broadly explains it. We are not expecting any significant market improvements, certainly in the first half of the year. It is still challenging out there for us, but I think the opportunity for me lies in half two and the years beyond, because a lot of that optimism that you see from the market sectors that Mark's just talked through, I think is back end of FY25 into 26 and 27. So hopefully that
yeah, great. Super.
If you want me to answer that last point, Paul, it's not my wife bashing me over there with a frying pan. I've had a small procedure on the top of my head, nothing to worry about, all under control.
Yeah, and for those who haven't seen the question is, I hope the bandage is nothing to worry about. But the final question, and then we'll move to close, is what is your fleet utilisation rate, and what could it be in better conditions?
Well, do you want me to say that one? So I'll maybe just jump to the statistics slide, which you'll be able to see on the screen there. So the average rig utilisation over the last year has come down. Hopefully the message has come through that it has been a challenging second half, certainly. And you see there, utilisation 51%. Previous year was sitting at 61% across the board. If you exclude rail, and you need to bear in mind that our rail division in the UK historically has only worked weekends, and we do occasionally get midweek work, particularly if there's a large electrification program, which, as Mark's already said, we haven't seen for a number of years. We can get midweek working where we sort of get bumper margins, but historically in the last few years, really, it's brought the weighted average down. So overall, 55%. Is our utilisation excluding rail, 65% in the prior year. What could it be in good times? At the top end, 80% is almost fully utilised. These rigs have to move around the country and they have to be maintained. So there is always a time where they're taken out of service for maintenance and transport. We can get them over months trading, 100%, but over a long period of time, over a year, 80% would be, near full utilisation. At 65%, that was, that in the prior year, we were reasonably busy. But we had our downtimes as well with the market conditions in the prior year as well. So look, I think if we're getting up towards 70% utilisation, 65 to 70% utilisation, the company's performing reasonably well.
Super, great. Okay, lovely place to stop. Thank you, Mark. Thank you, Graham. Could I ask investors not to close this session, as you will now automatically be redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Van ELLE, please do get in contact via vanelle@walbrookpr.com. Thank you all, and thank you, Mark, and thank you, Graham.
Thank you.
Thank you.